Welcome to PNJ training. In this section, we cover Q factors, forecasts, and special topics under a SC 326, mastering qualitative adjustments and expected credit losses. By the end of this lesson, you will understand how to bridge historical data to current conditions, how to apply a three-phase forecast horizon, and how to handle specialized asset types like purchased credit deteriorated loans and off-balance sheet exposures. The CECL estimation formula has three components that work together. You start with historical loss data as the baseline. This anchors the model in observed reality. You then layer on Q factors to reflect current conditions that history alone cannot capture. Finally, you incorporate forward-looking economic forecasts to account for where things are headed. These three inputs combine to produce the total expected credit loss that goes into your allowance. Qualitative adjustment factors, known as Q factors, exist to bridge the gap between what history shows and what conditions look like today. Historical data models only reflect the past, and no quantitative model can fully account for changes happening right now in your portfolio. Q factors are judgmental adjustments applied on top of those quantitative models. They can increase or decrease the allowance, depending on whether conditions are deteriorating or improving relative to the historical period. The directional impact of Q factors follows a consistent logic. A worsening economy, rising unemployment, contracting GDP, widening credit spreads pushes the allowance up. Loosened underwriting standards, such as relaxed credit reviews or reduced collateral requirements, also push the allowance up because future losses are likely to be higher than historical rates suggest. On the other hand, improving conditions and rising collateral values can support a decrease. The key is that every directional choice must be supported by specific evidence, not general sentiment. Every Q factor adjustment carries a documentation mandate. You must document the specific category of the adjustment, the direction and magnitude of the change, and the underlying reasoning that supports your conclusion. A statement like economic conditions are uncertain will not survive audit review. Auditors and regulators expect specificity. For example, the unemployment rate in our primary market rose from 4.2% to 6.1% over the past 2 quarters, which we estimate increases loss rates in this pool by 15 basis points. That level of detail is what passes the standard. CECL requires incorporating forward-looking economic forecasts, and this plays out across a three-phase forecast horizon. Phase 1 is the historical period, where you establish your baseline using 3 to 5 years of actual write-off and recovery data. Phase 2 is the forecast period, typically 1 to 3 years for most companies, where you adjust loss rates for expected future economic conditions using external consensus forecasts on GDP, unemployment, and credit spreads. Phase 3 is the reversion period, where loss rates are brought back to historical norms, either through an abrupt switch or a gradual straight-line reversion over 1 to 2 years. The length of the forecast period is not prescribed. It must be supportable with reliable data, and that choice must be documented. Purchased credit deteriorated assets, called PCD assets, arise when a company acquires a financial asset that already carries more than insignificant credit deterioration since it was originally created. The buyer already priced in the credit risk when negotiating the purchase price, so recording an additional day 1 credit loss would double count that risk and produce a misleading result. For this reason, standard day 1 loss accounting does not apply to PCD assets. Instead, a different approach is used at acquisition. PCD assets use what is called the gross-up approach. At acquisition, you start with the purchase price, which represents fair value, and you add the estimated allowance for credit losses as of that date. In this example, the purchase price is $80,000, and the estimated credit loss allowance is $15,000, producing an initial amortized cost basis of $95,000. Both the asset and the allowance are recorded simultaneously, with zero profit and loss impact on day 1. The journal entry debits loans receivable for $95,000, credits cash for $80,000, and credits the allowance for credit losses for $15,000. After acquisition, any subsequent changes in expected credit losses flow through credit loss expense in the normal way. Off-balance sheet credit exposures also require a CECL assessment each reporting period. These include unfunded loan commitments, financial guarantees, and letters of credit that are not unconditionally cancelable. The key distinction from funded loans is where the expected loss is recorded. For a funded loan, the allowance is recorded as a contra asset. It reduces the receivable on the balance sheet. For an unfunded commitment, the expected loss is recorded as a distinct liability, sitting within other liabilities rather than as a contra asset. Both require identical estimation rigor under CECL. The presentation location is the only difference. Bringing it all together, a complete CECL estimate operates like an adjustment engine with 4 elements. You anchor your models on historical truth. You adjust for today using documented Q factors. You project tomorrow through the 3-phase forecast horizon. And you apply structural rules for specialized assets such as PCD loans and off-balance sheet exposures. These 4 elements working together produce a defensible, auditable, and forward-looking allowance estimate. Thanks for watching. If you found this useful, subscribe to PNJ Training for more videos like this. Thank you for watching. Subscribe for more training from PNJ Group.